Hey guys, this is Chris. Welcome back to another Stock Dads video, and today we're talking about 5 stocks down 50% or more. These stocks have been cut in half and treated like trash, but is one man's trash another man's treasure? We're gonna go through all 5 stocks in terms of what I think, if they're a strong buy, a hold, or a sell, their valuation, their growth over the past few years, and this year especially with the whole bear market and recession thing going on. We have their balance sheet, cash and debt, and then we're going to talk about other long-term potential interests in this stock. So if you like these type of videos, make sure to give this a like and subscribe to the channel if you haven't already, and let's get started. So the first stock we're going to talk about is one of my own favorites, and that is Meta stock. And a lot of people hate this stock, but I think that right now this stock is actually a strong buy for the long term. Of course, we're talking about these in terms of investments. So why I think Meta is great, if you look at its valuation, it's trading at an incredible 11 PE ratio right now. It's just astonishing. That's well below the market average right now, but also for the next 12 months. When you look at the forward PE for the S&P 500, it's currently still around a 15 or 16. And that in itself is also below the 5-year average and the 10-year average. So Meta is already trading at a very undervalued, discounted valuation here. Now, when it comes to Meta's business model, it is struggling just with the macro environment and digital ads spending being cut by a lot of companies, but also you have the app privacy issues, which are causing Facebook ads to not be as effective as they used to, which in turn advertisers may not want to use Facebook, even though it's still one of the biggest things out there. Instagram is still one of the biggest platforms out there, but there is still a little bit of a pushback there. And then you also have TikTok being a more major competitor now, and advertising spending is definitely going towards there. If you look at our TikTok page, we're definitely seeing some traction there. If you haven't already checked that out, be sure to do so. Growth is on a downward trend right now. They posted their first negative revenue growth quarter in Q2 of this year. But historically, Facebook has grown 30% compound annually for the past 5 years. And going back to its IPO days and early startup days, Facebook has always seen a lot of growth. But at this point, they're kind of plateauing at a super high level, and the environment does not favor them. But at this valuation, I say that there is very low risk already. A lot of people think that Facebook is not going to grow its profits as much, but Facebook is also cutting its costs a lot. Jumping a bit here, but towards the metaverse, right? Facebook is burning a lot of money, billions and billions of dollars per year. Even if Facebook's revenue is slightly dropping now, if they're cutting costs, they should be able to maintain a very high net income amount. Over the past 12 months, they've had about $40 billion in net income, which is incredible. And when you look at the balance sheet, also $40 billion in cash. So they do have a lot of money to spend. Their current ratio is also very high, about 2.5 here. So they're not in any crisis per se. They're just in a bit of a crisis with growth. But as far as the balance sheet and the valuation, you have a really good company here. And once again, the metaverse is not really priced in here. Facebook is spending a lot to try to figure that out and also grow its AR and VR. Just came out with the $1,500 headset. If they ever sponsor us, I would like to try that out. I think that there is something there, and eventually with this much money to throw at something, I think Facebook could probably figure something out and solve that, and could once again drive that revenue growth. Moving on to stock number 2 is going to be AMD, and this one right now is my favorite semiconductor company. So AMD has had tremendous growth, and when I first started investing in about 2017, AMD, I recall, was something around $10 per share. It went up as high as $150 per share. And when its CEO, Lisa Su, took over the company many, many years ago, she took that company from a $2 stock and irrelevant when it comes to the semiconductor space, all the way to one of the biggest competitors out there. So that in itself is a big reason why I think this stock is right now a strong buy. So before we get into some of the valuation growth here, just AMD in general as a company, as a competitor in that semiconductor space, has been killing it, right? Its stock price has not been going up for no reason. It's been coming out with the most innovative products out there. It's taken a lot of market share from Intel. If you look at this graph here, you'll see that in this particular area of the market, AMD has gone from like a 20% market share to a 40% market share. and just eating it up from Intel. And they've said themselves over the past 8 or 9 quarters, they've been consistently taking market share away from Intel. And Intel's stock price hasn't really done anything, and their company hasn't been growing very much. Maybe a 5% clip, a 10% revenue clip, but AMD has been growing like crazy. So their past quarter, their revenue was up 70%. And if you go back to the past 5 years, they consistently put up 30, 40, 50% revenue growth every single year. So it has warranted that premium valuation. But in this bear market environment now, AMD actually does not really command a premium valuation anymore. It has a valuation P ratio of 25, which is a bit high for this market, but its forward PE is somewhere around 15 right now. And historically, AMD is traded at 35 to 50 PE ratios. So it's already come down tremendously here. For that premium growth, I think it's worth it. Now, a bad thing about AMD here is, number one, there are a lot of semiconductor laws and restrictions coming out towards selling to China. And AMD's exposure to China is not as big as NVIDIA. So that's why I have AMD on my list to watch here of stocks down 50% or more. But it still has an impact. Then you have slowing PC demand here. And one particular segment of AMD is focused on that PC market and notebook market. And that revenue is expected to come almost $1 billion under their guidance, which definitely sent the stock down recently. But I think in the long run, all of those growth trends are still going to be there. You go, I should have put this over here because I keep jumping to long-term potential, but AMD's long-term potential, you have Internet of Things, all these connected devices, they need chips to work. And then you have data center, just in general data, artificial intelligence, these things are going to be huge. And AMD sells into consoles and gaming, even though gaming has slowed down. That's pretty much going to be the future. And you go back to the metaverse, right? We're going to need AMD to power all of that stuff. Now, in terms of the balance sheet, $6 billion in cash, twice the amount that they have in total debt. So not a company that is once again under pressure here. And they're definitely going to survive this market. By the way, guys, if you want to follow all of our market moves in real time, be sure to check out the Stock Dads Discord. This is our premium Discord trading community for stocks, options, crypto, and sports betting. We have a whole lot of value in here, from daily real-time alerts, live trading sessions, trading tools and resources, one-on-one mentorship. There are almost 2,000 members in our community. Stockdads.com, and you could also check out the link in the description. Moving on to stock number 3 here is going to be Netflix, NFLX. All right, this one is also a very contentious one. There are probably some people watching this that are going to say, why are you recommending this woke company? Whether I recommend it or not, we're going to talk about that in a second, but we're going to mainly stick to facts here and not their type of content. But full disclosure, I do have Netflix, I guess. So Netflix, I'm going to actually say this one is a hold for me. I wouldn't really be selling this if I had this in my portfolio either. So Netflix currently trades at a PE ratio of 21. If you look at the growth rates, I think Netflix can actually grow its revenue and profits by about 5 to 10%. For the next 12 months. And if you look at their Q2 earnings, they actually weren't bad. They actually grew a little bit. And if you go back to Q1 and last year as well, you'll see that the profit trends for Netflix is actually improving. So this company is actually starting to make more and more money off of their revenue. Now, their subscribers are kind of stagnant here. So they have about 220 million subscribers. They actually burned some subscribers earlier this year, which is why the stock went down so much. I'm really thinking about that net income growth potential here for Netflix. Like, if they can continue to make more money off of their subscribers, which is kind of simple, you just, once again, jumping here, raise prices, all right, and you also add that ad tier, I can't spell, tier, T-I-E-R, tier. These are things that Netflix can pull on, these levers, and just immediately make more money. Now, the question is, what is the churn rate once you start doing ads, and then once you start raising those prices? Now, to try to augment that, though, Netflix is kind of trying to raise their value proposition by adding, I need more space here, gonna be ugly, but games, right? So they have gone out there and bought a lot of game studios over the past 12 months. If they can raise the value, then people will at least stay and hopefully be willing to pay more and reduce that churn rate. For that balance sheet though, Netflix doesn't have the best balance sheet. The current ratio is about 1.1. They do have a lot of debt on their balance sheet, and they are burning a lot of cash, of course, to go out there and develop those games, buy those game studios, and also with that original content and competing with the likes of Disney and HBO Max. You know, this was once upon a time the only game in town. Now we have so many choices out there as consumers. Stock number 4 on our list is going to be another contentious one for a lot of people. It is going to be coin stock, C-O-I-N, Coinbase. For me personally, I'm gonna say this is a buy/hold here for a couple of different reasons. Now, in terms of the valuation, it's very, very hard to value Coinbase because it is an extremely volatile business, and they've said it themselves. So in good times for the crypto market, this company makes billions of dollars in net income, like nobody's business. In good times, this has a PE ratio, I remember, of around 5, but in bad times, they could lose billions of dollars. Right now, the price to sales ratio, if we X that out, the price to sales ratio is about 2.7 here, which is not the worst ever. If you look at some highly unprofitable companies, they might have price to sales ratios of 5 or 10 or 20. Right now, the market does not like unprofitable companies. You kind of have to buy it for the long term here and what you think of when it comes to the crypto market outlook. If you think Bitcoin will eventually be $100,000 and will have another bull run, if you juxtapose Coinbase's stock price history, which isn't very long, but if you do that, compare it to the Bitcoin price chart over time, it's pretty much an exact correlation. So to summarize that, right, growth for this business, you can go from 0 to growth to like 100% growth. So very volatile. It's definitely a growth stock. It's definitely one that you want to tread lightly if you're more of a value investor. Balance sheet wise, it does have $6 billion in assets to spend, and more assets than liabilities. It also has about a 1.1 current ratio. They've said they will try to reduce their expenses, and they've done a hiring freeze. So I think they're aware of not spending too much money here. So theoretically, if you didn't want to invest in Bitcoin directly or any of the cryptocurrencies, you could invest in Coinbase. And I forgot to mention for Coinbase, for the long-term potential, besides the Bitcoin recovery in the crypto market and prices and trading activity, you also have the partnership with, not Goldman Sachs, with BlackRock, biggest asset manager in the world, basically. And then you have recently the news with Alphabet, aka Google, coming out. So that could definitely be very interesting if they keep seeing big institutions come to them for anything crypto. Lastly, number 5 is going to be PYPL. That is PayPal. PayPal, a lot of people have liked this one historically. They have had a high valuation in the past with PayPal, anywhere from like a 50 PE ratio to maybe a 30 PE ratio. Right now it's trading around a 40 PE ratio, so it's still high, but they are expecting their profits to improve, and they actually raised their guidance. It's kind of surprising how much they've grown over time. So you kind of get jaded with how many fintech companies are out there. If you go to the app store, if you even just think to yourself how many apps that you use, it's kind of crazy how much overlap all of these companies have and how many have gone on the market over the past couple of years, that you kind of wonder, should I even invest in PayPal anymore? I think that with its track record and the huge amount of just expansive reach that this company has, and it's always had about a 20% revenue growth for many, many years until this one. And the fact that the valuation is coming down, if it stays at this current stock price of around 80, going back to my rating, I would say PayPal is probably a buy here. A slight buy, if not a hold. Moving on to the balance sheet, I think it is decent, but it's not the best. So they do have about $4 billion in cash here, if I'm not mistaken. And then you follow that up though with $10 billion in long-term debt. So yeah, they actually have $15 billion in cash and cash equivalents. Obviously, that's why they're able to do a $15 billion share buyback for this company, and that could raise its stock price over time. The long-term potential here, I think the ecosystem here is just the biggest thing for the long-term potential. They have talked about getting into crypto. Obviously, you could do some crypto trading with their digital wallet, payment processing for other companies, just more and more products. And over time, you do expect that e-commerce and everything digital is going to continue to grow. So overall for PayPal, I would say it's a buy or hold. Not as interesting to me as Meta or AMD for sure at this price point. So there you guys have it, 5 stocks down 50% this year alone. Some big names out there: Meta, AMD, Netflix, Coinbase, and PayPal. Let me know what you guys think in the comments down below. And if you want to start investing while the market's down, be sure to check out Moomoo. This is the trading app I use. We have a whole dedicated review video to that as well. Be sure to check it out. And I will see you guys in the next video. Good luck investing.